welcome to yet another special Crystal Ball. It's been interesting going because volatility has come back to the market after such a dream run, and the big question is whether we are in for a period of consolidation or correction in the market for the next few months before the next leg of the up move begins. Madhu Kela of Reliance Capital is my guest on Crystal Ball today. Madhu, very good to see you after a long time. A few wobbles for the market. What do you expect to see in the next 5 or 6 months? A continuation of the rally, a consolidation, or a correction?
Yeah. Good, Udayan, good to see you as well. It's been a long that we interacted, so thank you very much for having me. I think, as you rightly said, Udayan, we had had a dream run in equities in the last 12-18 months. Even the indices, forget in the rupee terms, but even in the dollar terms, they're up anywhere between 80 to 120% between Nifty, small cap and mid caps. So whenever you have such a tremendous run in equities, obviously you have to take a step back and think whether the party is there for longer term. So I feel that, if you have a medium-term perspective, which is like 3 to 5 years, there is still a long way to go for this bull market. However, in the very near term, I think consolidation could be a decent way to describe this market, because we have had such a big rise in individual companies also. So market should digest this rise, and before we go to the next level, I'm sure it has to get supported with the ground reality improving and the visibility of a much faster earning growth in the markets, so that we can take the next leg forward.
How would you describe this consolidation, Madhu? The markets may choose to do one of two things. It may just go into a range for many months, maybe an 8,500, 9,000 kind of a range. Or do you think that the market has the prospect of a deeper pullback, getting to maybe even 8,000 or sub 8,000 Nifty levels?
I would say, Udayan, let's not put the numbers. I would say markets is more likely to consolidate, because for a few days, a few weeks, the numbers can be of anything. But I would rule out a much deeper correction beyond 8,000, because let's say that if you are in a bull market, one of the characteristics of the bull market that is always will climb the wall of worry, and there is no doubt in my mind that we are in a longer term bull markets. So and second characteristic of the real large bull market is that it doesn't give you a much deeper correction, which in other words means it doesn't give a free entry to a lot of people who are left out. So time wise correction to me looks a much bigger probability than the price wise correction. And let's also accept the fact that the leaders of this bull market, whether they are pharmaceutical, whether it is technology, or even FMCG companies or auto companies, even in this correction, they are not correcting, and they form a significant portion of the Nifty weightage today. And I don't see a situation where, these companies, let's say for instance, technology companies are not very expensive. So I do not see a situation wherein they can, crap out or give a very big correction. So I feel time-wise, obviously we will need to spend some time, and that could get extended to 4-6 months in this broader range of the market before we take the next leap.
What's the next trigger, Madhu, for this market? Because so many triggers have played out, and you can think of 2 or 3 reasons like valuations, earnings, maybe even global reasons why the markets might face some hurdles in the near term. But can you think of 3-4 things in the next 6 months which can lead to a big rally in the market?
So there are 2 big triggers, Udayan, which have been. One is the earnings re-rating, which is there in the card. Obviously the ground reality in the last 6 months have been very muted. But I expect maybe 2 quarters down the line, there will be much bigger earning jump which will be visible to the market if you take a 2-3 year perspective. So once that starts to kick in and you have 1 good quarter of surprise results, then I think markets will start to factor in. The other big trigger, Udayan, is the flow of domestic money. Trust me, I've been interacting with a lot of people. people have not yet participated. The domestic people, the retail people have not yet participated wholeheartedly. And the other asset classes, there is such a big challenge. You see, real estate has been stagnant for last 2-3 years. People are finding it very, very difficult to exit their real estate investments. Then you have gold, which is crashed out. Basically, last 2 years there has been no return. Fixed income yields are falling, so there was some money to be made in the fixed income side. I think that money will be there for the next 6-9 months more. But the businesses itself are in challenge. So where do you go for return? And equity, on a contrary to everyone's expectation 1.5 year down the line, has done quite well. So I think the continuous trigger for the market, I think every decline you will see big flow of domestic money, and that is why I rule out a possibility of a much deeper correction, because it will get supported.
One of the risk factors that you spoke about, Madhu, which is earnings. In all honesty, most of us would have expected earnings to have ticked up by now, but they have not. Last year, maybe even 4 quarters back, we were saying by the start of 2015, earnings will definitely have ticked up, but they did not in the quarter gone by. Is there an uncertainty in your mind that maybe, like we said 4 quarters back, that earnings would have picked up by now, 2 more quarters will pass, but earnings would still not have ticked up? What is the level of patience for this market, where it keeps waiting for earnings to catch up with valuations? And at what point do you think there could be cracks led by disappointment?
This is one point I agree completely, Udayan, because markets have been hoping that earnings would pick up, and to my mind this is the biggest risk which we are facing in the market, because if you see the bipolarity in our markets, whatever is performing, wherever there is quality, they are disproportionately valued. I would say to the extent of saying some pockets of quality look overvalued to me. And wherever there is no performance, market is just not interested to look at any value, any bigger themes. So the earnings have been very disappointing in the other pocket of the market. However, the pocket which has been performing, whether the P multiples are 30, 40, 50, 60, there has been support of earning, not to the extent the valuations have run up. So I would say, I would completely agree with you that if we do not get a clear visibility of earning revival, even in the next 2 quarters, there are not decisive signs that earnings have bottomed out and things have started to improve. I think at that time market will take a very serious view of the earnings. So I am still hoping that I would say still government has done a tremendous job. Let's give it to them, from where they have taken it over to do a coal ordinance and to do an entire coal auction in matter of 6 months, something which did not happen in 60 years. All this will start to show results maybe 1 or 2 quarters down the line. Now, what I am watching in an immediate term, which I said last time in my budget interaction also, is the budget session and not the budget. So basically we have to see whether the government politically can pull through all these reformist ordinances which have been pending, barring 1 or 2 which will always be pending. But I think if they can pull it off, then all this will come in handy in pushing the earnings growth maybe 2-3 quarters down the line.
You spoke about high quality stocks with high valuation. As a professional investor, what is your approach to these sets of stocks? For example, pharmaceuticals, great companies, very high valuations right now in many cases. Is there enough margin for safety to go out and still accumulate these stocks, or do you feel nervous? I
think you have to have a portfolio approach then, because we don't know. I've learned one thing in my life: highs are higher than what we think and lows are lower than what we think. That it's not for me to decide what is the highest valuation and when I should exit. I think till the time these companies are still delivering 20-25%, 20% plus earning growth, and the broader environment is still in their favor. So we are running a portfolio approach rather than running a very skewed approach. However, we keep evaluating on a very constant basis. There are one or two pockets of companies which are becoming expensive, where I think even from a 3-year perspective, it is very hard to make money even if I assume 20-25% growth. So in those pockets, clearly we will be diluting our stakes, and we will be selling off and getting into something which is still reasonably valued. So I can tell you in pharma sector, still there are companies which are trading, let's say, 18-20 times from 1 year or 1.5 year forward perspective. That is not expensive. But there is other pockets in the same sector where you find companies are trading at maybe 35, 40 P multiples. So we have to be careful about individual companies in these sectors which are, in my view, have extended in terms of valuation. So it is a bottom-up approach in these sectors rather than top-down.
At this point, we'll slip into a break. Back with Crystal Ball and Madhu Kela in just a minute.